In the stock market, we have these things called options, and options are a very powerful way to invest or trade. Most advanced traders or investors have looked into options at some point or even have options as part of their portfolio. Today, I'm going to teach you what an option is. Let's go. Welcome back, guys, to another video. My name is Nick, and on this channel, we cover tech and finance. If you're interested in these topics and want to learn more, don't forget to hit that subscribe button down below. Now let's get into the video. So what exactly is an option? Well, an option contract gives you the right, but not obligation, to purchase 100 shares in a company. Now, in terms of the actual contract, there's two things you first need to understand. The first is the strike price, and the second is the expiration date. This means that you need the underlying, which is the stock that the option contract is valid for, to be at a certain price by a certain date for your option contract to be valid. When dealing with options, you have two ways to play them: calls or puts. Call options are bullish, which means you're expecting the stock price to go up, and put options are bearish, which means you're expecting the stock price to go down. So putting this into perspective with an example here, if I buy one option contract in Tesla with a $400 strike price and a January 2018 expiry date, this means that I'm expecting Tesla to be worth at least $400 a share by January 2018. If for whatever reason the stock price does not hit or exceed $400 by January 2018, my option contract at that point would become worth $0, meaning you would lose all of your money. Now, there are three terms that you need to get yourself familiar with when trading options. The first being ITM, or in the money, the second being ATM, or at the money, and the third being OTM, or out of the money. So now, going back to our Tesla example, if the stock price is below $400 on the expiration date, that means we are out of the money. If the stock price is at $400, that means we're at the money. And if stock price is anything above $400, that means we're in the money. You ideally want your option contracts to be as deep in the money as possible, because this would make your option contract worth the most and would provide you with the most amount of gains as well. But one thing you need to make note of when trading options is that on the expiry day, if your option contract is in the money or at the money, your broker will most likely exercise the option. And this means that it will cash in that contract for shares. So if you're holding one option contract in Tesla at $400 strike price, your broker is going to execute that and purchase 100 shares of Tesla at $400 a share for you. This means that you need to make sure that you have at least $40,000 cash in your stock account, because they will purchase this on your behalf. And if you don't have the funds available, you're going to owe your broker whatever the difference is in cost. So because of this, people typically sell their option contracts before expiry date so that they don't have to purchase the shares if they don't want to. Now, another important aspect to option trading is that there are these things called Greeks, which pretty much determine how much an option contract will move depending on how much the underlying moves. Now, going to these Greeks gets a bit complicated, so I'm going to save that for another video where I go over the option chain with you guys. The biggest risk with option trading is that you are risking 100% of the money that you put into that option contract, because that contract could be worth $0 if it's not at the money or in the money at time of expiration. Now, in theory, this is very risky, but there are ways you can play options to lower your risk and improve your chances of coming out profitable in a trade. If you guys want to see my strategy on trading options, leave a comment down below and I'll gladly make a video on that as well. So now let me shift gears and use an analogy with a real-world example of how an option contract works. Say you have a coupon that gets you a $10 burger for $5, but this coupon expires in a month. So as long as this coupon doesn't expire, it's obviously valuable because you save $5 on the burger. Now, other people would be willing to pay for your coupon because it does save them money from a regularly priced $10 burger. So theoretically, you could go ahead and sell that coupon for, say, $7, and someone could purchase that and use that coupon towards a $10 burger and still save $3, and you've made $2. So in the end, everyone's happy. Now, if the restaurant drops the price of the regularly priced $10 burger to a $3 special, that coupon that you have to get the burger for $5 instead of $10 is pretty much worthless. Why would anyone want to use that coupon which enables them to buy the burger for $5 when the restaurant's selling it directly for $3? Makes no sense. Likewise, if your coupon expires, it's worthless as well because no one's going to want to buy an expired coupon. So now the same thinking can be extended to the stock market with options. As long as we are still within the active period for the option contract, meaning that it hasn't expired yet, and as long as your contract is still in the money or at the money, your contract is worth something. Now the closer we get to expiration date, the more volatile your option becomes because there's a higher risk of it closing above or below the strike price by the expiry date. If the price of the underlying does not hit or exceed your strike price, your contract is going to be useless when it expires. It took me personally a while to understand the whole reasoning behind why people trade options, especially since my broker charges so much for commissions. For example, for every option trade that I make, I have to spend $10 on commission plus $1 for each contract that I'm buying. So for example, if I want to buy 10 call options in Facebook, this means my broker is going to charge me $10 flat fee, $1 per contract, so that's another $10 right there, which is $20 to buy the call option. And then when I want to go sell it, another $10 to sell plus $1 per contract, so another $20. In total, I'll be spending $40 on commission round trip to trade these options. But now comparing this to shares, 10 call option contracts would equate to 1,000 shares. For 1,000 shares, my broker charges a flat fee of $6.50 per trade, which means my round trip cost is around $13, which is $27 cheaper than trading options. However, the drawback here is that I need a lot more capital to purchase 1,000 shares of Facebook versus 10 option contracts in Facebook. So if we look at the call options, for example, and we assume that they're trading at around $1,000 per contract, if I purchase 10 contracts, that's $10,000 worth of contracts that I'll be holding. Now on the flip side, if I wanted to purchase the equivalent 1,000 shares of Facebook, if we assume the stock price is around $170 a share, that means that I need $170,000 worth of cash sitting in my account to be able to purchase that many shares. As you can see, you only spend a fraction of the amount of your capital when it comes to options as opposed to trading shares. But the drawback is that you pay more in commissions and you have a higher risk of losing your whole investment. Whereas when it comes to shares, you're not constricted to a time frame. So you could hold those shares indefinitely, and as long as the company does not go bankrupt, your shares will be worth something. But now on the flip side, if you trade options and you are right with your trade, you will be rewarded much more than you would be with a stock trade. Typical successful option trades result in at least double-digit percentage gains, meaning at least 10%. But it isn't uncommon to have hundreds of percent of gain as well, or even the occasional 1,000% gain. Remember, when it comes to options, it's high risk, high reward. So I hope this video helped you understand what options are in the stock market and how powerful they can be as an investment tool. The risk is higher, but so are the rewards. I will be making a follow-up video on how to read an option chain, so if you think that would be useful or valuable to you, leave a like on this video. Alright, that's the video guys. Thank you so much for watching. Don't forget to hit that subscribe button down below to support the channel. So my question of the video is, do you trade options? Let me know in the comment section down below. But either way, I'll see you in the next one. Peace.